Hey everyone, welcome to the KE Report in a pre-market daily editorial with Dave Erfle, founder and editor of the Junior Minor Junkie. It's October 15th, and we are going to start with silver because tail end of last week, even early this week, we saw something a bit rare happen in silver. We saw some backwardation. So the spot market priced higher than the futures market, and at one point, I think the difference was about $3, where spot was well over $50 an ounce and futures was still kind of right around $50 an ounce. Look, there's a lot in the precious metals community about why this is happening, what makes the spot market go higher. We're hearing all these stories outside of the US about silver shortages. Yeah, the fact of the matter is, look, silver's broken out of $50. It's continuing to move higher, but Dave, any insights that you have on backwardation, whether just this one that we saw in silver or it hasn't happened much, but the other times we have seen backwardation in either silver or gold?
Yeah, it's really interesting when this is taking place too, Corey. We've got this 45-year cup and handle breakout in silver at the $50 level, right? And I mentioned the backwardation in my column, my Kitco column on Friday. It's when we have a severe physical shortage in a market, and that's what's happening in the silver market. And what we had on Friday was at the Friday close, silver closed in the spot market at 50, and it closed this December futures closed at 48, which means people want their silver now. So the price now is what at the close last week was last Friday was $2 higher, and this morning before it kind of got back into a realignment today, it got up to a $3 difference. I mean, I saw stories of people shipping silver on cargo ships. It's super expensive, but they want to take advantage of that difference. And a big shortage in India and Australian Mint not being able to sell silver, and just all these crazy stories. But the last time something like this happened in a big way in silver was when the Hunt brothers tried to corner the silver market back in the late 1970s. But like in 2011 and back then in 1979, that $50 level was an intraday move. Silver shot up there and then came right back down. And then we had a long bear market result because of the price spike. That's not happening now because silver's been in a structural deficit now. This is the fifth year. So we've got all these things converging at once. We've got silver in a structural deficit. We've got supply strains. We've got people having a hard time getting silver, and we've got that technical 45-year breakout. Everybody's been looking at that $50 level for a long time. So now you got momentum players coming in, and silver is a tiny, tiny market in relation not only to gold but in relation to other markets. So this is a huge event here, and I mentioned that at one point that it could get up to 55 to 60, but I think spot got to $53 and change before they came back into alignment today. So this squeeze could be over, or it could pick up again. I have no idea.
Well, Dave, it really is a historic moment. I have been waiting for this for 15 years. I remember when I was getting started in 2010, 2011, and I saw that first move to 50. It was so fleeting and it was over before you knew it. This one's different because, as you point out, it's hanging up here and it's not a one-day event or an intraday event. We're sticking at 50 on both the spot and the futures. And you would think, because it's also in the backdrop where gold is also still making all-time highs every day and every week and every month, you would think that there would just be a fever pitch in silver right now. And there is a lot of excitement, but it's, after waiting this long and after waiting for 45 years from the 1980 high to see it stick, do you think that there's some people that were waiting for silver to get hit? Because just anecdotally, I talked to people that were waiting for it to go to 49 or 50 and then pull back in the low 40s, and that's where they were going to load the boat. Do you think a lot of people missed loading the boat?
Yeah, I mean, a lot of people were caught flat-footed. I mean, the reason why it's happening this time, we've got liquidity and trust in paper markets have recently begun to deteriorate. And we've got a Federal Reserve that is lowering interest rates while inflation continues to rise. and people losing faith in institutions all around the world in governments. This is all converging at the same time, and all, in the geopolitical situation, going on, and we've got the wars going on in Ukraine, and with that the Ukraine-Russia situation, and we had a monumental peace deal, which was fantastic in the Middle East, and then we had the metals sell off on that news, but then Pakistan and Afghanistan are started to fight, and all of a sudden we've got more geopolitical situations rising up. So I've never seen so many tailwinds in the back of gold and silver. I mean, there's just so many. When one falls by the wayside, another comes to replace it, and all these governments, continuing to borrow endlessly without ever intention of paying any of it back, and all this converging at the same time has weakness being bought in both gold and silver very quickly. I mean, last week we talked about, okay, this kind of looks like an area for a top. We've hit the targets of 4,000 gold and $50 silver. We've had all these headlines of gold, of institutions recommending gold stocks, and gold stocks doing so well, and gold doing so well. It's hit the headline. So we thought, okay, this is a natural place for a pullback. And the mining sector was echoing that as well. We had back-to-back weekly reversal candles in GDX and GDXJ. But lo and behold, yesterday, we had everything go right back up again. The weakness was bought almost, weakness continues to be bought, um, almost as soon as it sells off. So it's almost like you could just throw technicals out the window right now, because all of these bullish converging bullish reasons to own both gold and silver, and especially the mining stocks, which still have a long way to catch up, even though they're short-term overbought. So all this is converging to where, hey, whenever there's weakness, we're buying.
So, Dave, with this whole backwardation, though, one thing we keep hearing about silver is its industrial uses. And people are trying to make the argument that we're seeing the silver shortage because the industrial uses are taking hold. But all the reasons you're outlining are kind of the geopolitical, kind of the more precious metals reason. And silver, it seems like right now, at least, being driven a lot by those precious metals demand. So, again, the shortage in silver, I guess it's investors coming in saying they just want silver now because prices moved up. Is there anything on that whole supply demand that you are seeing true shortages out there because of its industrial uses?
Yes, I mean that is a big reason. I mean, it used to be 60/40, right? Meaning 60% of precious metal and 40% industrial metal. And now that's flipped. I think it's a 60% of industrial metal now and 40% of precious metal. But I think a lot of people that missed the boat on gold are also looking at silver because it's a cheaper alternative. I mean, just look at the CPI adjusted price of gold was cleared several months ago, right? For the first time since 1980. But if the CPI adjusted price for silver is four times higher at $200. So, when you got at the same time, when you've got that cup and handle breakout, 45-year cup and handle breakout, technically speaking, and CPI adjusted speaking on what the price is, and silver's so much cheaper than gold for people who can't afford an ounce of gold. I mean, in Canada, it's almost hit $7,000 for an ounce of gold now. So silver is a cheaper alternative if you want a safety net.
Poor man's gold. It's back in favor. Well, Dave, I got to ask you, we always end up getting into the equities, and we haven't even seen the numbers yet from Q3, which was the all-time highest quarterly average for gold and silver. And now a lot of people thought, well, that's going to be great for Q3, but what if it pulls back in Q4? We're actually seeing an acceleration into Q4. Now we're only just, a few weeks into it, but the companies that pull this out of the ground, whether it's gold or silver, or some companies doing both, are literally printing money here. Do you think, I mean, the stocks are moving, but how much of this is priced into the stocks at this point?
That's a great question. I think we talked about this last week. I don't want to repeat myself, but the gold price went up, I think $600 in Q3, and the oil price went down. And diesel it makes up to 50 to 60% in costs of most of these miners. A miner like Newmont, who's, most of their mines are these big, huge open pit behemoths, right? And they just guzzle diesel. So 50% of their cost is diesel. And oil's gone down while gold's gone up. Look at the gold oil ratio is sinking fast. I mean, it's remember the spike low we had during the COVID scare? It's getting down to those levels where it looks like, wow, it's just crashing. So these margins are just huge, and Newmont's got a report next Thursday, so it's going to be interesting to see how much of this is priced in.
So, Dave, where are you seeing the opportunities in the gold stocks? Yes, we do talk about this all the time, but I find the start of this week very interesting where gold really shot up to start this week. A lot of commodities and even the market shot up to start this week as Trump talked nicely about what could happen with these China-US tensions. Big rebound day on Monday, but the Canadian markets were closed. And quite frankly, a little disappointing to see the follow through on Tuesday, or lack thereof follow through by some of the venture and TSX listed companies without the US symbols. Because again, US was open on Monday, everything shot up. Where are the best opportunities in the gold stocks?
Yeah, I've been saying this for a while now. The best opportunities are in the higher risk, earlier stage juniors. These companies that have just put out an updated mineral resource estimate or a maiden mineral resource estimate, and they're about to issue a PEA on the back of it. I've invested in a couple of companies like that recently, and recommended them to my subscribers. So I think that's where the really high beta is now. But there's still a lot of upside to the later stage companies, but they've moved up so much, 3, 4, 5 times just this year alone. So they're obviously due for some profit taking. But yeah, I think that's where the higher beta is now in these higher risk juniors. But there is, it's higher risk, but it is higher reward because they really haven't even moved yet. A lot of these companies are still trading at less than $60 an ounce in the ground, and some of them are trading at even less than $20 an ounce on the ground that have millions of ounces in top tier jurisdictions.
Well, Dave, just to that exact point, I'm surprised by two things. I want to get your thoughts on this. I'm surprised we're not seeing more projects that hit the go button and say, okay, we're building this thing. Like at these metals prices, we have got to build it. Let's get the capital stack together. I mean, I know some of it's depending on permits, but if permits aren't the issue, why are we not seeing more projects fast tracked? Number one. And number two, where is all the M&A, Dave?
Yeah, it's amazing. I didn't go to the Denver Gold Forum. I just went to Beaver Creek. I didn't go to Denver Gold Forum, but I've talked to people that did go, and M&A wasn't really the buzz. I mean, these companies are still concentrating on, on healthy balance sheets, paying dividends, buying back shares, making sure they don't make a big mistake like they did back in 2011 when the gold price was screaming higher and they were paying $1,000 an ounce in the ground when gold was trying to bump up against 2000. It got to 1925 and stopped. So they don't want to repeat those mistakes. But if you look at these juniors now and they're trading at these levels, I mean, even the ones that have gone up 3, 4, 5 times, they're still trading at less than $125 an ounce in the ground. And when you think back that these companies were being taken out for $1,000 an ounce in the ground when gold was only 1,900, you just kind of go, wow. I mean, there's still a long way to go.
Do you think we need to readjust our expectations in terms of M&A? Because it's not just in mining, it's in all these sectors. Shad and I covered it in a quick take, I think it was last week, that showed that every sector is more focused on mega deals rather than the smaller deals. Total deal volume M&A wise globally is up year over year, but the number of deals is down, I think about 10%. So are we kind of still living in a fantasy thinking that all these juniors are just going to get bought out when you think about it, 15 years ago there are actually more majors that could have done that buying?
Well, I think it's going to happen. It's going to take a little longer, which is fine with me because the companies that I hold that I recommend to my subscribers, they've gone up quite a bit so far, and we are expecting a takeout down the road at a substantial premium, but we'd rather let them go a lot higher on their own before that happens. And I do expect it to happen, but these companies also, they're also making inroads of building it themselves. They're hiring the right people to build the mine themselves. So, they've got the wherewithal, and they've hired the right people. They've lined up the cash, they've got the financing, and they're going to build it themselves. I mean, that's fine too with me. I don't have to get my junior taken out because I still think there's still plenty of upside. So I'd rather see them run on their own before they get taken out at a higher premium from a major or a mid-tier.
Yeah, it's a solid point. It's a bittersweet moment when you get that takeover news, and so you don't want to see the valuation clip before they have a chance to run. But Dave, I got another one for you, and we've talked about this before, but for the love of goodness, when are companies going to put metal sensitivities on that are somewhere close to reality? We are still seeing companies with $1,800 or maybe $2,000 gold assumptions, and their upside case is $3,000 gold. We're at $4,100 gold. The silver companies, it's the same problem. I mean, we are now above 50. Sure, it may not stick, but there's still people using $22, $24, $26. When in the world is the industry going to stop shooting itself in the foot and at least put some spot sensitivity tables on their slide decks, like real time, like go to your website and update your slide deck?
Yeah, that's a great question. I'd love to see it too. They are starting to do it, as well as they'll use a base case of 2000 or 1900 or 1850 gold or whatever, and then they'll show, okay, these are what the numbers are at spot prices. These are what the numbers are at 4000 gold. These are what the numbers are at 5000 gold. That's what I'd like to see now in the future. And you might start to see it, because especially with some of these companies that are de-risking lower margin projects, they need a higher gold price above 2,500 or 3,000.
So, Dave, how do you analyze these economic studies then? Because at these current prices, yeah, even lower margin projects are pretty high margin right now. Everything works at these price levels. And if it doesn't, boy, oh boy, then no one should be focusing on it. But look, if everyone's just going to put out blow away numbers, do you simply just normalize all these numbers to whatever number you want and then compare them? Or how do you filter through all that noise of the promotional angle of it?
Well, first of all, I look at what the valuation is to their peer group. I look at the jurisdiction. I look at how long it's going to take to permit. That's a big one, because some of these projects, they're getting close to being at the feasibility stage, yet they're still not going to get their EIA permit even for another couple of years. They haven't even gotten into the environmental permit process yet, which takes a couple of years in top tier jurisdictions. So I look at that, because that's what the market's looking at. They look at, okay, look, they've got all this gold in the ground. It's really high margin. It's really high grade. This project's going to be fantastic. But oh wow, look, it's not going to be fully permitted until 2029. So there's a lot of things to look at.
Dave, do you get a sense when you talk to management teams, because I know you do Zoom calls with them and you talk with them at conferences, that there's still a sense of disbelief about these prices sticking? Because again, even when you were mentioning the sensitivity table, you're like, some are starting to do it. They're starting to include 4,000 gold as their upside case, but right, that's a downside case today. It's 4,100, and the upside case for silver, a lot of them are in the 40s. I don't think that the management teams that we've talked to, or that I talked to in meetings at conferences, really believe. Like, it's almost like they can't believe how good it's going, so that surely it can't last, because this whole sector has PTSD from all the times where the rug got pulled out. Do you think that's causing people to be so conservative that it's actually hurting the sector? And why I ask that is, if this was a tech company, they would be doing the real price as what it is now. If this was retail, they would be talking about where prices are now for their forward price assumptions and sales assumptions. If this was almost any other sector, they would be looking at where prices are now. Is this whole industry too gun shy because of past failures?
Yeah, that's a great point, because we're all used to sitting around wondering when the next shoe's going to drop, right? Oh, it's great that gold's going up so much, but when's the next shoe going to drop to where we get the rug pulled out from under us and we have that big correction? But that's not happening. All these corrections are being bought quickly. So yeah, I mean, as far as juniors are concerned, there's still I still see a lot of touting of their project, saying, how wonderful their project is. It even works at this number of gold, and we just have to do this and this. I think more conservative, the conservativeness is coming more from the producers, because they have to worry about cash flow metrics. If the gold price starts to crash. So it's really interesting how this is played out in the sector, because it's like you said, it's almost like they're all still gun shy. They haven't put their bull market hats on yet, even though the gold price has gone from $3,000 to $4,000 in just 200 days. I mean, we had a gold price bumping up against $1,000 an ounce back in 2008, and it took 12 years, almost looked like 11 years to get to 2000. And then once it bumped up to the psychological level of 2000, it bumped up there a few times, and it took 4 or 5 years to blast out above 2000. So it took just about a year to go from 2000 to 3000, but it only took 200 days to go to 3000 to 4000. So we're starting to see a parabolic rise in the price, and yet, like you said, it's almost like there's a disbelief among management teams.
I think there is, in a way. It's both, I think, a blessing and a curse for this sector, though, where there is an underlying price that everyone points to because everyone in the end game is producing the exact same product. There's no differentiating between an ounce of gold, whether it comes from North America, Asia, Africa, anywhere in the world, but it's all priced in more or less one unit, right? So I think people are a little bit surprised at how quick it's moved, especially in the sector. And yeah, they should be embracing it more because we don't know how long this cycle is going to last. But we're clearly in a bull market cycle, and a bull market that is further accelerating, whether it's mid innings, late innings, who knows? Fact of the matter is it's still a bull market. But Dave, anything that we need to look out for on the horizon that could either further drive prices, that could cause a slowdown in prices? It just seems right now that gold, silver is almost a momentum play outside of any news. But is there any news we should be watching out for?
Yeah, I mean, just like we've talked about, there's so many bullish factors out there, and once a bearish factor comes into a previous long-term bullish factor, another bullish factor comes in to replace it. I don't know if that makes sense, but you know, the big thing is geopolitical. I think that's the big mover, and the loss of faith in institutions and loss of faith in governments. I mean, the new French government lasted 14 hours. They replaced a prime minister for the fifth time in 2 years, and he lasted 14 hours. And we've got the Bank of England and France announcing that they're probably going to need an IMF bailout. I mean, this is loss of faith in the financial system, and I don't see that going backwards. I don't see that flipping around and all of a sudden everybody's gains their faith back in finance and institutions again. So as far as the gold price is concerned, I mean, I would be concerned if it fell below 3,500 anytime soon. I mean, that would be a big drop. I mean, it's been due for at least a 10% correction for a while. But as far as the gold price is concerned, I see, a correction in time more than I do in price coming up.
Well, Dave, if we're able to sustain these prices and if the pullback is through time, not in price, and we, stay in the high, let's say 3,000s, low 4,000s for gold, and if we stay in the high 40s, low 50s for silver, what does that mean for the more marginal projects, the optionality plays, if you will, that, like you talked about, some of the lowest cost ones can shine the most, but if we use this price, it's not going to have the exact same effect across the board on producers, on developers' valuations. It's going to have a disproportionate effect on the lesser quality companies. Is that an area where investors may be able to see outsized returns?
Yes, and that's what I talked about earlier when you asked me where I saw the value. I mean, it's the optionality plays that are still under the radar and not getting much love from the market. I mean, a lot of these companies, let's, for instance, you see a lot of these late stage juniors, they've had these huge moves along with the miners, along with the streamers and the royalty plays. They continue to make all-time highs, right? But if you go down the food chain to these earlier stage companies, these optionality plays, some with quality projects, they're still trading at 50, 60, 70% below where they were trading in 2020. So that's where the value is. And
I
I
mean the
think,
lesser quality projects, so Dave, the ones that are maybe not your top picks, not top tier one. Those projects could actually be, this could be their moment to shine.
they could absolutely, but I still wouldn't touch them. I can't recommend a stock that is a company that is de-risking a project that I don't feel is quality. I can't recommend that to my subscribers, even though it's a pig that may fly. I still can't recommend that to my subscribers.
Yeah, fair enough. Those stocks, though, those are the ones that haven't moved as much over the last, if you consider this bull market for stocks last March when the precious metals price broke out. I think it was above $2,000 an ounce. That's when these higher quality stocks ran. A lot of these higher quality ones are up 5, 6, 7, 10x at least. These marginal ones, they're up maybe 2, 3x recently. So I guess those do still have the best opportunity to run if we stay in this environment and more money comes in. They are higher risk, but well, now is the time to take on higher risk because higher metals prices really takes away some of that risk because these prices are so high as long as they stay elevated. But hey, overall, gold well over $4,000, silver over $50. What a time to be in precious metal stocks. Dave, we'll wrap it up here. Thanks for your time on this pre-market daily editorial. Everyone click that link in the show notes to visit the Junior Miner Junkie website. Follow along with Dave Erfle. Dave, have a great rest of your week.
Thanks. You